So great to see everybody. My name's Erica Duignan-Minahan. Today I'm going to be talking to you a little bit about startup investing for 2020 and particularly some opportunities that we're finding in the crisis. So if you guys are not familiar with me, I've actually spent the last 14 years of my career investing in seed and Series A. Prior to that, I spent 8 years doing traditional public market investment banking at firms like Salomon Smith Barney, Credit Suisse, First Boston. Also spent a few years as a general partner for Dream It Fund, the Dream It Ventures Fund, and I'm a general partner and co-founder at Rain Ventures, which is also a seed stage fund. So during that time, I've invested in over 100 early stage companies and have worked with thousands of startups. So, what we want to talk about today is investing from the perspective of, where I sit in the capital structure, which is really sort of seed through late Series A, early Series B rounds. And, I work with loads of investors, family offices, high net worth individuals, and of course, seed funds that we co-invest with. And we wonder, is there a right way to think about investing during a crisis? Well, to answer that question, we have to think about the various purposes of making an investment in a public market stock or a startup or a growth stage company. And there are a couple reasons we do it. So one, of course, is to create financial return. Two is to solve problems. Three is hopefully to change the world. And lastly, we probably want to also be improving the world. So if we think about these core reasons for why we make investments, we want to think about, what's changed for this thought process in 2020 and how can we actually meet these four objectives regardless of the chaos that is happening around us. So what are some of the new themes that we've seen this year? So, I think the first one that we can really look at, and, these are sort of some quotes from some thought leaders in the industry, is that the personal has now actually become dangerous, right? So where is there opportunity there? Well, there's a movement towards doing things online. There's increased risk with every additional thing that you do in person. So the typical things we're used to doing now feel risky. And online communication really has to become more personal and more commonplace. So there's going to be an increased value in limiting interaction. And this is an amazing investment theme that we've seen for early stage companies in 2020. The second is that regulatory and social barriers to online tools are going to continue to fall. And you may have noticed that there has been a tremendous surge in telemedicine and in ed tech. These two areas that were, sort of not exactly the favored sectors of early stage investors are now really the darlings of the industry. If you know college students or you have kids in college, you're going to realize, you're going to see how college students are realizing the efficiency of online learning, and that going forward, people will realize that most in-person meetings, could have been a Zoom for a lot less time and effort and money. And a third theme that we've seen really take off this year is that people are looking to lead healthier digital lifestyles. So online streaming of fitness and wellness classes is becoming widely accepted and needed. I think that actually November 1st is like the first month that our in-person gyms are even, set to reopen. And, given that all of Europe is now back down in a lockdown, we'll see how long this goes. So people are really just the barriers to adoption for moving online have been greatly lowered. Live streaming is being adopted on a grand scale. Everyone's seen, the DJ sets and the rise of Clubhouse and other sort of like live communication tools. And people are really learning how to connect with each other personally with digital tools. And the late adopters that have always prevented these industries from growing fast are just being forced to jump in the pool. So, that technophobe, boomer that you might know is now probably really comfortable with Zoom meetings and FaceTime and other digital methods of communication. And, another important thing is that there's going to be a change in our understanding of the word even change. So people are going to be more open to doing things in a different manner than they ever were before. And, most importantly, we're looking at a paradigm shift in recognizing what's really, really important in our lives. And to understand that old habits are going to be broken to make room for new behavior that will likely stick with us long past the recovery from this crisis. And then, one of the things that we're really hoping to see, which clearly, takes a little bit more time, but we think that this move to digital will eventually really be a boon to virtual reality. And these are much more sort of long-term investment opportunities. But, as people integrate digital communication tools more in life, high quality VR tools are going to become more important. As more of life just in general goes digital and streaming, the experience will benefit from being enhanced. So we think that the timetable for VR adoption, which was probably going to be, over the next decade, might actually get pushed up. And of course, as you guys know, there's probably going to be less, there is less communal dining, but people are actually getting more excited about the experience of cooking at home. So we know that there is actually a huge opportunity for folks who are able to provide clean, prepared foods and takeout, because as much as we want to stay safe, we still want to eat delicious foods, get that convenience, and, have an opportunity to break bread with friends. So why do we think that there is opportunity, right, for us as investors? And, the big question is, can early stage investors benefit from what was really the previous overcapitalization of startups, right? We're entering kind of what will likely be a somewhat capital constrained environment. And while, it's not been incredibly negative for companies that are, raising early stage rounds, certainly there's been a pullback on, the sort of vast amount of capital that was available over the 20 teens. So, a couple themes here is, number one, agility will really become a strength. So companies that are burning cash will become unsustainable and will be weeded out. And you've probably already heard that, by Q3 2020, these sort of cash burning companies have, flamed out and closed their doors. So you're going to see the market sort of eliminate, some of the weeds and make room for new growth. So the new landscape is really clear, right? So we now know what are the most pressing problems and opportunities, and we don't have to guess. It's sort of the need between the nice to haves and the need to have. So because, we're in a position where our needs are much clearer, it's a lot easier to determine whether or not a company is actually addressing the needs of the new economy, as a great deal of frivolity is actually being flushed out. And another thing that is a positive for early stage investors is that valuations have improved. So rounds are being priced at slightly more attractive valuations for investors who have cash now and are willing to take risk. But they've still remained in healthy ranges, and they've not been pushed unreasonably low as some people might have expected. So, there was certainly a sense that maybe, people were going to be able to get amazing deals because companies would be desperate for capital. But the Fed's actually kept the capital markets pretty open and pretty liquid. Obviously, this week we've had a little bit of a pullback, but for the year as a whole, things were not as disastrous as expected. And another thing that can be very positive for early stage investors is that we do expect there to be less dilution. So the move away from overcapitalization and wasteful spending will probably reduce the risk of dilution to early investors and hopefully result in better outcomes at exit. But the important thing to remember is that we're not seeing a contraction in availability of early stage capital. So if you're out there trying to raise money, don't worry. There is money for you. VCs are very busy. They spent, Q2 and Q3 really focused on existing portfolio companies. And this actually opened up a lot more opportunity for angel investors to participate in direct rounds in the spring and summer. But now that pent up supply of venture capital is being deployed. So if you're in the market looking to do a seed or Series A round, these guys haven't been writing checks into new companies for a while, so they're ready to start doing it. It's very good timing. So great to meet everybody. Wonderful to talk with you. And if you'd like to learn more, please visit us at 1000angels.com or rainvc.com.